Welcome to New Home Insights, the podcast from John Burns Research Consulting. I'm your host, Dean Worley. If you want to follow market trends, demographics, capital, new ideas, and endeavors that touch on housing, we're going to try to make sense of that every couple of weeks. Let's go. Hi, everyone. This is Dean Worley with the New Home Insights podcast. This past spring, we had a couple of folks who do our builder surveys on the show to kind of give us a real-time pulse of the market. That was one of the most popular shows for the entire year. So when I say that we have those folks plus one back by popular demand, I'm not just making that up. That really is true. So we're going to take a look at the market more recently, what's been going on through the summer into the fall, and then maybe a little look ahead of what we expect, at least for the near term, into the future. To do that, we have three of the folks who do our John Burns Research and Consulting surveys. Those are, I'm going to go from my screen, Cara Lavender, Jody Kahn, and Dillan Krieg. How you guys doing?
We're great.
Doing good. Good to be here, Dean.
We're doing good. Thanks, Dean.
Before we start, so folks who are just listening can put kind of name to voice. Let's start with just a little brief intro, what you do here at John Burns, and then we'll get moving.
Awesome. Well, hey guys, I'm Cara Lavender, and just like Jody and Dillan, we work on our surveys here at John Burns. So getting a pulse on the market, looking at for sale, for rent. We're looking at the resale market, new home market, land market as well. We do it all. So we're all working on our survey team, and I'll pass it over to Jody for a little intro.
Okay, thanks, Cara. I'm Senior VP of Research Surveys at John Burns, been with the company almost 17 years, and the very first mission when I joined was to launch our builder survey. So we have been surveying every single month since June 2008, which still blows my mind, actually, to think how long we've been tracking.
We do forget that sometimes too. This has been going on for a long time, which gives us a lot of historical data, which is and trend data, which is great. Dillan?
Yeah, my name is Dillan Krieg. I'm an analyst here on the survey team, and I am very blessed to work with Jody and Cara here on driving our kind of qualitative and proprietary surveys to really get a read on really what's going on in all sectors of the housing market.
Yeah, and really is kind of as close to real time as you can get. And it's national. The depth of these surveys really is hundreds of builder respondents in every sector of the country. So it gives us a really good picture, both nationally and regionally. Let's start, though, by setting the scene with a little bit of a recap. Dillan, give us a little recap of what we were looking at last time we did this. You were with us. You and Jody were with us on that episode of what the spring selling season was looking like then.
Yeah, I think the spring season was really interesting this year. So bit of a reminder, the spring selling season, as we call it, is really kind of the strongest, typically, period of new home sales throughout the year. And one of the strongest times for real estate activity in general, just during that spring season, generally in the March, April, May, those months in particular are usually just the strongest out of the year. And this year was really interesting. I would say that if you really just took a look at mortgage rates, they tracked very well with whether or not folks were exceeding, meeting, or kind of falling behind their expectations for how they thought the spring season and first half of the year in general was going to be. January had rates below 7% in the 6% range. And really, January, February, they were pretty good. Builders were very happy. It exceeded their expectations for, January is usually pretty cold and a bit dreary. So those were pretty good. But once we got into those kind of core spring selling season months, March, April, May, rates went up to 7%, 7.5%. And while they weren't bad, they were still a decent spring selling season. Builders sold homes. They had traffic. There was a lot of movement. But those rates really kept kind of a cap on the activity, which made things not as jubilant as a lot of folks were kind of hoping and expecting them to be going into the year here, especially with that really strong January.
Can I ask you a question, Dillan? Yeah. Can I interject for a second? Do you think, and we'll get to this, the more recent later on, but we know things slow down. I'm not giving anything away. I'm not a spoiler alert there for that. But do you think we are looking back on 2024 from now, the current review mirror, with a little bit of a jaundiced eye, because we were expectant and so much, as you said, jubilant after a great January and February. And so we kind of switched to our expectation of something really like, this is going to be a great 24. And then it kind of wasn't. It was an okay 24. do you think that has kind of colored how we perceive 24? Because that is to say, it's a little better than we maybe think it was.
I think that's correct, Dean. I think it's a little bit of expectations versus reality. Really, I think the expectations for 2024 spring season were really high. And don't get me wrong, it was a decent spring selling season. It wasn't like it was, falling apart at the seams or a disappointment, like totally, but it really didn't meet up to the very high expectations that a lot of folks had coming into the year.
Yeah. I feel like if you had asked folks in October of 23, hey, here's what 24 is going to look like, and it looked exactly like it looked like, they would have said, I can take that. I can live with that.
Yeah. I think that's entirely right. And I think really part of it too is that, we're looking at a bit of a different market right now in terms of how builders are performing. So when we look at, sales in general, sales have really held above the seasonal average throughout the year. Bit of a spoiler for currently as well, but they've held above the seasonal average for what we expect sales to really be at. And that includes during the spring season period. However, when we look at more of the pricing, some of the traffic statistics with who's coming in to the homes, that is definitely has been muted throughout the year, and especially on pricing, because that really goes into why builders had actually a still pretty decent spring season, despite the many, many headwinds that they have in the market right now with affordability. And that's really going to be through their incentives, through move-in ready inventory, and just their limited resale supply that they're facing. So those incentives are very, very helpful for builders, particularly at the rate buy downs. They cost a lot of money, but they're less expensive than reducing prices on the home, and they really give buyers more bang for their buck there. Of course, that means builders have to pay for those incentives. So that does keep some of that pricing power for builders a little bit muted. However, because of it's been able to kind of really counter the affordability pressures that buyers are facing. It's been a huge advantage for builders and really helped them keep up their sales paces. In addition to offering a lot of standing inventory, quick move-in homes, especially in times where there really wasn't a lot on the resale market. Resale inventory is improving now, but it's been very low for a very long time at this point.
Yeah, that inventory picture especially is something we keep track of. And Jody and I have talked about this extensively where, how much inventory do you want? You want a decent amount of inventory because you do want to be able to compete with those resales that do come on. And that definitely having standing inventory ready to move in absolutely helps sales month to month to month. But if you get too much, it gets risky.
Yeah. And one thing to keep in mind, too, is that a lot of this move-in ready inventory is also part of builder strategies, not just to capture some of those buyers who would go to the resale homes, but because of some of the financing that is needed for the rate buy down incentives, a lot of those actually require a quick to close home because some of those buy downs, the builders only have 30 or 60 days in which to actually put them on closing. So you need something that's ready and able to get a buyer and then close in a pretty quick manner.
Yeah, we call it selling dirt, which is to say that you're selling homes that are not yet in the process of construction. Honestly, in the worst of times, folks were still not offering buy-down incentives on selling dirt. Those were full price. So it's always the 30, 60-day stuffs on the interim. The problem is, though, is that we want to keep a gauge of the market. And if every sale is that sort of heavily discounted QMI, not just 1 in 5, but every sale, then that's the market. So we always try to keep a close watch on how much that stuff is the kind of price to move and how much is priced more normally. Cara, tell us about how things have been going more recently, especially in terms of sales.
Yeah, so I think a lot of what Dillan has just talked about really has carried into the second half of 2024. Things are going solid. They're not going gangbusters, but they're not falling apart at the seams. The solid performance we saw in the spring selling season through summer, it's really continued despite the rates, hovering around 7 and even rising through October. And so they're going well. I think the big takeaway here is kind of that seasonality has returned and people have to accept that. We're starting to see, those month over month seasonal shifts that we saw pre-COVID that just totally became muted. And so those are coming back. But when you look at the long history, and, we talked about this, we have data back to 2008 in this survey. So we know what a pre-COVID normal year looks like. And when you look at, say, sales and starts rates, builders in October were like averaging around 2.9 sales per community, 3 starts per community, which maybe was a shift down month over month. But you're looking at it in, with a rear view mirror, looking at 2012, 2019, both those sales and starts rates were 20 to 30% above that seasonal norm in October. That's pretty impressive. So I think that's a really exciting point that kind of gets lost in translation when some of we're not meeting these high expectations that builders set forth at the beginning of the year. So it's a really solid October. We're going into, they're using those buy downs. They're using a ton of incentives like Dillan touched on. And that definitely is starting to weigh on the pricing power. I think during that spring season Dillan was talking about, builders were reporting, I think, roughly 4% year over year price growth. We've seen that come down steadily through the year. So it's continued to decelerate. And most recently looking at like 2% year over year price appreciation, which isn't bad. It's not great, but it's not bad. But you can just see that the incentives are really starting to take a toll on the builders, but they're doing what they need to do. They're getting sales across the finish line.
Yeah. I love that sense of normalness, by the way, or how we measure normalness or normalcy. I think that word was made up by Warren Harding. I'm not sure. But if you will look back, we've had such a weird history here in these last 25 years that there really might almost be just a couple of periods of normalcy, something like 2000, 14, 15 to maybe 19. Obviously 20 is out the window. And then you really honestly, because of the weirdness of 03 and 05 and the stated income, and you had a pulse, you got a 5-bedroom home. And so you have to back to what do you think, Jody? Late 1990s to early 2000s as the other quote unquote normal period. That's two in a very long time. So it's been a weird market for a while.
Not even sure there's really a normal in housing because it's so susceptible to rates. But also there have been tremendous policy changes over time, even in the last 12 to 15 years, that have significantly changed the whole how do we qualify buyers. So it's really hard to compare to older history that was much more freewheeling. Like I can remember the day when builders were allowed to fund buyers' down payments.
Yep. Yeah, and that's a no-go anymore. Cara, did I interrupt you? I think you were going to talk a little more about how builders are sort of acting and how builders are sort of adapting to the sales environment.
Yeah, definitely. It's really just pulling in both of kind of their strategy changes, talking about what they're doing during the sales process and what they're doing in terms of their production. And we obviously know they're utilizing all of these incentives, but it's really interesting to kind of watch how what used to be customize your home, personalize your home we've really strayed pretty far from that. But what's changed in kind of step with that is it's a much more personalized sales process now. So the home may not be as personalized. It's kind of an off-the-shelf production home, but that sales process, builders are working with every single buyer to really figure out that magic combination of what's going to get you to be able to qualify. What can we do for you to get you across the finish line? Is it, a rate buy down? Is it closing costs? Is it design options? Is it all three of them? And so the home may be a spec home and it may be, the same as the home next door, but builders really are making it a custom process in the terms of the sales. And so we can obviously see to that change in production strategy, the spec homes they're being accepted. They're what it allows builders to get those rate buy downs, to have those quick close. We were looking at their 2025 forecasts and 53% of builder starts are planned to be spec homes. So starting that home without the buyer in mind, without releasing it for sale. So we know the spec strategy works. It allows them to, focus on the custom sales process. It allows them to rein in their costs. It allows them to do the quick closes. So it's a phenomenal strategy on all of those fronts, but there definitely are some things that are showing up, and that's the inventory. So we've talked about the elevated resale inventory. There's elevated new home inventory too. And it's really that spec strategy is what is fueling it. So it's not just, the can rate is normal. It's not cancellations fueling this elevated new home inventory number, but it's the builder's shift in strategy, which is what's allowing them to get sales. And of course, we can talk about regionality with that too. There's huge regionality differences in the inventory conversation, particularly Florida, Texas, Southeast. I think Florida's new home finished inventory number is double year over year what it was. That's huge. And we can see that slowing down their sales. We see the softer pricing in Florida and Texas. We've downgraded a lot of Florida and Texas markets in our new home rating. And so the inventory, both new home and resale, is definitely weighing heavy in more of those regions. But you do see places like the Southeast that have this rising inventory due to the builders, change in spec strategy. But the Southeast builders sales are holding up pretty well. It's when you look at what's happening in Florida and Texas.
Yeah. Yeah, but Florida, I think, is mostly because people finally realize they have alligators, and those are terrifying. And so,
Took them long
how
enough.
it took them a long time. They weren't sure what those things were. They thought they were friends. In terms of you mentioned the packages and the specking up front. Little aside here. Do you think? I mean, we're seeing a lot more builders go with those packages. It's not just Meritage anymore. You think you'll see that just becoming more and more common? Here's 3, 4, 5, whatever packages. And we want to get ahead of the build schedule. We're going to spec one of those packages for you. Do you see that becoming increasingly the norm?
Yeah, most definitely. And there are some builders who are on the opposite side of that and are going to stick to their custom strategy, but that is definitely not the broad market trend right now. What we're seeing is even move up homes, even luxury builders are making it a more simplified process. They're not giving you nearly as many options, or they're just going straight to that option package. And another thing that benefits builders, if you're letting a home buyer come in and just customize this home, put purple cabinets with yellow floors, if that
love
sale
it,
falls
by the
through,
way, loved it. I just want to say that. But,
then that being able to sell that home if that buyer falls through is just not ideal for the builder. So they know that they can spec the home to their highest take rate options. They know they're going to get good margins on those options. They know that it's widely accepted, and it really smooths things out both for the builder and the buyer. So it's a give and take. Obviously, people are missing some of their customization, but to be able to get the rate buy down, have a quick close, control costs, it's definitely been what's helping the builders and buyers out.
Well, I hear builders kind of marketing this like you don't get a choice. They'll say like, these are curated selections by design experts who, parenthetically know how to make a home look nice and not the purple and yellow combo that Cara suggested. And I think there is some validity to that, but I really think it also helps a lot on the purchasing side in that the builders can use their scale to get better pricing. And as we've already said, affordability is a big issue. So if the builders can negotiate better pricing because they don't have to buy 82 types of cabinets, but maybe 5, that helps a lot.
Yeah. I'm feeling a little attacked here on my purple and yellow choice because those are complementary colors. If you guys could see my blue and orange kitchen right now, I think you'd agree with me or not. Incentives, I just had Jody especially, are all of you actually, is anyone doing like weird, clever, out of the box incentives these days? Like, I'm giving away a car or things like that. Jet skis if you buy your house now. Do you see that ever happening? Or is it all just buy downs and closing costs?
I have not seen that. The trend we've noticed recently that's pretty interesting is builders offering a 30-year fixed rate. So they're buying down the rate for the full 30, and then they're layering on top of that a short-term buy down for the first couple of years. So one of the builders that we follow is offering like 1.99 for the first year, stepping up to 2.99 the second year and 3.99, and then reverting to their, I think it's roughly 5% is the buy down. So it's that layering effect that gives a really startling low payment that first year or two.
Yeah, that's interesting. I've seen 299, but I haven't seen 199. Interesting. Go ahead, Cara.
I was just going to say, I'll also add something that I think maybe not a lot of people expected to see is following the NAR settlement. I feel like a lot of builders were always quick to, say, okay, we're not offering commissions to the buyer agent anymore or finding any way they can to have buyer agents not come in with their buyers. But we actually saw several builders kind of double down on their relationship with agents and encouraging them, letting them know that they're still going to be offering commissions and really fostering the relationship with buyer agents, which I don't think a lot of people necessarily expected, but I think buyers are just having that as another tool in their tool belt to keep demand coming in.
It's funny you say that because I just heard this the other day of a little bit of a flex move by brokers who this broker came into this builder, a major builder, by the way, and sort of said, look, I've signed a 3% contract with my client, so you need to give me a 3% broker co-op to cover that or else. The or else is illegal effectively, but still there was sort of this kind of a threat. And in markets where the broker community is critical to the buyer traffic, I can see that playing. In markets where it's not so much, and frankly, this one is a little bit more of a food court, so I think it was a hollow threat. But have you heard about that? Do you think we'll see them trying to make the new home builder cover their now ambiguous co-op?
I think a lot of builders already took some pretty strict steps when COVID started, when everything couldn't build fast enough. People had been coming in and then, halfway through the sales process saying, oh, actually I do, my cousin is my agent and, we have to cover their commission kind of thing. And a lot of steps were taken so that, if you don't walk in that sales model the first time with your agent, that agent's not getting a commission. So I do think, you're going to have some one-off instances of that, but a lot of builders have taken the steps to make sure they know upfront if this sale is going to have a 3% commission attached to it.
Okay. We'll see. My guess is because most new home submarkets are fairly active. When you're in a one-off in a kind of a market that doesn't get a lot of new home activity, I can see that playing, but otherwise my guess is not. How about in terms of buy downs being with us forever, and should we get used to them? Are they here forever? I remember earlier in the year when rates did go down, when buyers had discretion. In other words, here's a bucket of money. Do you want to do buy downs? Do you want to do off the price? Do you want to do closing costs? Or maybe not off the price so much. They started shifting pretty quickly to closing cost over buy downs, even though rates were still pretty high compared to their handcuffed rate. Do you think we will be able to shed buy downs when rates just get a little bit of relief? Are we?
I don't think so.
Okay.
Yeah, it is true that we saw some shifting, but I think it really breaks out by buyer segment. For that entry buyer, the biggest hurdle is, can they afford that monthly payment and qualify? And that group pretty much always needs the rate buy down from what we can see. And often closing costs too. When you start going into the more upscale buyer, maybe an upscale, first move up, second move up, now you have people who can typically qualify, and therefore that flex approach works because, to Cara's point earlier, it allowed the builder to kind of really customize which incentives do you care about. And we've heard plenty of cases of buyers wanting to use the options and upgrades and really build a beautiful house and not have to, pay as much to get that perfect home because they can afford to pay the mortgage payment now and they're planning to refi when rates drop. So I think that flexibility is more meaningful for a buyer who can already qualify.
Yeah, and I wanted to add too, part of the question is not only whether builders will be able to, get off the buy downs, but whether or not they want to in the end. Because as Jody mentioned, there are these huge advantages for builders in offering these buy downs, all these incentives. And if you look at, a lot of the public builders, margins are still pretty good. They're still doing very well despite offering all of these buy downs because they give them such a competitive advantage over the resale market, and they really help out buyers in this really constrained affordability environment that we're in.
This might segue. I'm going to ask Jody next about how large builders are acting in today's market. But a good segue is along what Dillan, you just said, which is some of the bigger builders like a 7%, because yes, it constrains the supply and they're able to relatively more cheaply provide those rate buy downs than smaller builders. So it's kind of, it's not so bad. We actually had Doug Bauer from TriPoint on the podcast say exactly that. Jody, how are big builders acting in today's market environment?
The large production volume builders, which, by the way, are the folks that we're focusing on in our survey work, they have so many advantages and they are just dominating the new home sales, starts, and closings. Let me give you a couple of statistics here that I think illustrate this. First, there are 19 publicly traded U.S. home builders who currently are accounting for 48% of new home sales nationally over the last 12 months. That's actually kind of mind-boggling, almost half the market. Then if you add on to that subsidiaries of some publicly traded buildings or companies, such as there's 9 builders that are part of the Clayton Properties Group, which is part of Berkshire Hathaway. And there are some private builders that actually have public debt. That group are another 7% of new home sales, bringing the total to 55%. Okay. And we know of several large private builders that have a national or regional presence. I think if you add up these biggest builders, you're probably around 58% or so of all new home sales nationally. So that's really significant.
Yeah. What are some of the ways that they're doing this? What are the strategies that enable them or aid them in grabbing so much of the market?
I think I would divide the advantages into capital and scale. So they use their access to capital to compete for land and open new communities. So that's important. That's your footprint. And then they also are able to use the capital to offer those great rate incentives. We've talked a bit about those 30-year rate buy downs being so meaningful. There's another variant called a forward commitment, in which a builder that has a captive mortgage company will actually originate new mortgages for buyers at below market rates. So both strategies do tend to depend on having some quick closings through those quick move-in homes. But basically, these are expensive. And typically the smaller local builders don't have the capacity to offer these kinds of incentives. So this speaks to why the big builders are getting so many sales. Another factor is that the high production volume of these bigger builders enables them to really have purchasing power. And many of them will negotiate national contracts on things like appliances, for example, at a lower price point in view of the scale that they can offer nationally.
It gives you a flavor, by the way, Jody, of how these strategies really do dovetail, and they work kind of in tandem, where you have the mortgage, the internal mortgage, and the sales. It gives you a kind of a hint that consistent sales have become a super critical part of that strategy. So which is why these bigger builders are more likely to take that little hit on price, because they need those consistent sales.
That's right. That's right. And then those internal mortgage, and often they have a title and escrow operation too. That's part of that system of making sure that they can quickly determine if there's a buyer that's not going to be able to close for one reason or another. They can sort that out early in the process, replace that slot in production with another buyer that presumably can move forward. So it's a nice steady progress towards those steady closings. Also, these bigger builders spend on technology, and a lot of them have implemented integrated management information systems so that, for example, you sign a contract to buy a home in the sales office, and that purchase information is automated in terms of ordering materials, indicating to the superintendent in the field what's going to get built where, and so on. And it just kind of continues on to flow into accounting, et cetera. So it's it's a system that avoids miscommunications and is part of that strategy of steady production. That is exactly what these big builders are aiming for. And on the flip side, usually the smaller builders can't afford to or haven't implemented those kinds of the more expensive systems. A really interesting case of this was prior to the pandemic. A lot of the big builders had already set up those like 3D tours so that you could hop on their website and see sort of a walkthrough in the house. And so when the pandemic hit and there was a lot of worry about, can I go into a model home or should I go into a model home? Those big builders were set up that people could tour homes and even buy online. But a lot of the smaller builders told us through our survey work that they were not set up to do that. And so they were behind the 8 ball, first trying to figure that out while the big builders were selling homes right and left. So it's a big difference if you've got this capital and this technology.
Are we still seeing, I guess we'll get a little bit into M&A in a second. In fact, let's do that now if you want, Jody. Let's talk about what the big builders have done with respect to the bigger fish. I don't want to say swallowing the smaller fish because that sounds predatory, and it's not. It really is partnerships. Often these M&As are actually initiated by the smaller actor. So what's been going on there in the world of, I guess, conglomeration of the industry?
When you look at it from the buyers, who are typically the biggest builders, they're under a mandate to grow. If they're public, Wall Street is pressuring them to grow. But even if they're not publicly traded, they are looking to grow and they want to expand into new markets. There's a geographic diversification strategy. For example, builders that might be very heavy in the Southeast but don't have a presence in Texas want to get their toes in the pond. So there's this ongoing growth strategy, and we've already talked about how the bigger scale has so many advantages. so that you can understand from the buyer's perspective what they're looking to accomplish. And meanwhile, they also need lots and land. So sometimes they'll make acquisitions that really top them off in given markets. They might even already be in that market, and they'll add on a new submarket or just kind of expand their existing position. From the seller side, this is usually local or smaller regional home builders, and they're considering an acquisition because they're understanding that they need to reposition their companies to be more competitive. They're losing out on land deals to these big builders, for example, or they're not able to attract talent. They don't have the negotiation power with the local labor, and they generally don't have access to national contracts, right? So if they get that partnership, that acquisition via a larger company, they get all those benefits right off the top. They also get that move into those powerful integrated software systems. That's pretty much a mandate from day one, because that new division is going to need to flow its accounting up to the national view for the quarterly earnings calls and such. They get general financial stability too, which is important. We've seen a lot of bumps and twists and turns in the last decade in housing. And so that stability is really important. There's opportunities and there's survival, right? Double-edged sword there. But it also creates career pathways for employees. And I can't tell you how often that came up in the many years I worked in mergers and acquisitions in housing. It's actually kind of heartwarming to know that the principals of these companies care a lot about these handpicked teams they've created and that they've mentored and grown. And they want to know that those employees have a long-term pathway with growth opportunities, even if the principals at some point decide to exit the company or retire. And another big factor is getting rid of the personal liability, in that nobody expects a public builder to give a personal guarantee for the business loans, but it happens all the time for the small companies.
So they get
off that.
In 2007 and 8,
Yeah. And last but not least, the principals of a small company generally are reinvesting profits into their business. And so this kind of a transaction and acquisition creates a liquidity event for them where they can extract some of their hard-earned money and pull it out of the company. It will be replaced by funds coming from the acquiring company. So you can see it's a really nice synergy. The buyer and the seller benefit. And that's why these transactions are happening. We've had quite a few of them this year.
We have, and we're going to have more. Are there downsides for the bigger builder in this process, though?
Not very often. I've only seen a couple of cases where this just didn't work out well.
Okay.
I think over time, in the acquisition, the understanding of culture and fit between the two companies has really risen to the top of the heap in terms of one of the top 3 factors that you need to check out. So you don't want a situation. I can think of one case where a company that was primarily building affordable homes acquired a company that specialty or focus was really more high end, and it just was obviously not a good fit.
Yeah, that seems unusual that would get to the stage of there being an acquisition on that. You think you'd figure that? Because we've talked, Rich Moriarty was on not long ago talking about that. We've had everybody, Tony Avila and Margaret Whalen as well, talking about that. And that culture fit is a critical part of that M&A. And you usually try to discover that during the process. Let me give a little hat tip or a mention of the smaller builders, though, the private builders, though. Which, by the way, Jody mentioned we do focus in the surveys on the larger builders, but you do have a lot of smaller builders too. So we get some variety there as well. For those smaller builders, I don't know, are there a couple of things that you do strategically that help them compete in this, pretty rough world that seems to be more and more dominated by the big guys?
Absolutely. A couple times a year, either clients or people in the media will ask me if we're going to see a day where there's no private builders. I'm like, absolutely not. Yeah. The private builders are often very well connected locally, and they're able to use that for their advantage. They might have grown up with the people who are working in the jurisdictions making approval decisions, or those folks that are going to be selling land. etc. They're well connected. They often will take on trickier transactions that involve complex decisions, like, for example, infill sites where you're surrounded by existing uses. You really need to get the neighbors on board with you. Typically, a public builder is going to shy away from that. It's so much of a headache. They're not as well connected in local politics. And frankly, they don't usually yield a lot of lots, which is fine for the private, but, kind of not worth it for the public. So I think the privates will continue to dominate those kinds of specialty sites. And that can be things like close-in transit-oriented sites that have amazing sales rates when they can pull them off. A successful community that has that walkability or connection to transit.
Yeah.
So I think we'll see the private builders stick around. And right now, you've probably seen this, Dean, in your market. Some of those builders are actually taking sites through approvals, and then they're selling them to a bigger builder because they can actually make big money on doing that, maybe even more than building the homes themselves.
We see quite a bit of that. We also see, though, kind of the reverse of that, though. I do a lot of work in the Bay Area of California where any supply is supply you're going after, even the big boys. So in that market, you do see some of the big guys looking at that 17-lot infill kind of funky site thing, even though in a lot of markets that would be left for a private builder to do. How about, we mentioned upgrades and packages taking over. Could that be a way that the smaller builders continue to give buyers that discretion on kind of semi-customizing their home? Do you see that being a strategy?
I think that's a fair bet. I've seen some beautiful homes over the years that even modest cottages that just have a lot of thoughtfulness in terms of like built-ins and, conveniences. I think that is an opportunity for these private builders to differentiate themselves.
Let's switch a little more now for our last couple of modules into talking about the future. Let's switch now from past to present and future. Cara, let's start with you in terms of how builders are looking. What is the outlook? Are they optimistic? Are they pessimistic? What are they thinking about the near term, let's say next several months?
Yeah, builders are actually pretty optimistic. When we look at their forecast that we just surveyed about for 2025, they were reporting that they're expecting double-digit growth across sales, starts, closings, and community counts. So they're not scared for the future. They're pretty excited for 2025. I think what's interesting is when we've been talking about 2024 in the rear view, uncertainty has kind of been the name of the game the whole year. People waiting for rates to come down, what's going to happen with the election. There's been just a ton of uncertainty that has been shaping how builders are acting, how buyers are acting. And it felt like once the election's done, that uncertainty is going to go away. And I think that's just not the case. I think that uncertainty is going to continue to bleed into 2025, despite knowing the outcome of the election. And consumers are just dealing with a lot right now. We just got through this huge election. There's unrest across the world. Rates are unpredictable. People keep waiting around, thinking they're going to come down. They don't. They keep rising. And affordability is a major concern. So while builders are optimistic, like Jody said, they have these growth plans that they are going to set out to hit. They're going to increase their community counts and they're going to keep their sales steady. But I think we need to pay attention to a lot about consumer behavior, and affordability has been a major topic. And as long as rates stay up, they're going to continue to be a major topic. Consumers have less savings right now. They have more debt right now. We're looking at student loans that are weighing really heavy on first-time buyers. And I'm glad we actually touched on first-time buyers in the webinar we had yesterday, because this is a huge topic. They used to be a pretty sizable portion of all home buyers. And I think they showed yesterday that 24% of all buyers now are just first-time home buyers. That's the lowest percent of first-time home buyers in the data's history. So that's really significant, and we need to look at that. And it makes sense when you see these first-time home buyers. They are battling elevated home prices. They're battling elevated rates, the rising cost of insurance and taxes. It's making it really difficult for first-time home buyers to enter the market. And then on top of that, we mentioned the NAR settlement. And when we're looking at that now, it just is, it's a complex settlement and there's a lot of opinions around it. But when you look at it, we actually surveyed on this in our last resale survey. The vast majority of agents are adding language to those agreements that they're signing with their buyers that if the seller's not going to cover their commission, the buyer has to cover that commission.
Yeah.
And so, that's putting in, actually, that's just a whole nother pressure on these first-time home buyers. I have all these things working against me. Why am I going to go out if now I might be on the hook for another potentially 3% commission or whatever that commission agreed upon is. And it's just another thing that's weighing very heavily on first-time home buyers. They have a lot of things working against them. But, on the flip side, builders are working really hard to make sure they have things to work with those buyers, to work with the first-time home buyer. So it's a give and take, but I think that uncertainty is really going to be what continues to shape the demand going into 2025.
Yeah, we'll see. I mean, this is one of those things that, the old word disruption, which was almost as overused 10 years ago as AI is now. But the idea that you're going to foist that 3% commission onto the buyers is insane to me. I don't see that having sticking power. We'll see. I just upset a lot of real estate brokers out there. But
I will say we also surveyed, we asked because it's always been an agreed upon, it's always been something that's negotiable. It's just now that needs to be stated in a clear, concise way and in a written form agreement is pretty much what that settlement gets down to. But we actually asked agents if they're seeing what the commission sellers are offering, if they've changed. And I think it was over 60%, like almost 70% of agents were saying that they haven't seen what sellers are offering in terms of commission change. So there was, I think, roughly 20% saying they're seeing lower seller commissions offered. But right now, there hasn't been too much change. That may slowly trend differently, but right now, the majority of sellers are still anticipating to offer that buyer's commission.
Yeah, we'll see how that works. The affordability, though, like the way supply is, if you had to pick one thing that supports the housing market, it's supply, constrained supply, especially the new home market. If you had to pick one thing, though, that is a threat, it's affordability for sure, I think. And the fact that first-time buyers who are that conveyor belt, they are the first part of that conveyor belt that to move up and second move up that fuels the housing industry. When those folks are pushed out of the market by high prices, it's long-term not a good thing. We'll see. We'll see how that works.
All the more reason those builders have to really make a custom sales process, especially when they're working with a first-time home buyer. What down payment assistance can you get? What make the equation work, however it is for that specific person? And so all the more reason that sales process has to be more customized to those buyers.
Yeah. And builders are definitely being super adaptable about that and doing a lot of clever things to get those folks to sign and be able to afford that monthly payment. Dillan, I know you were following the election a lot, and Cara kind of teased about the election a minute ago. Before it was like, there's a lot of angst, there's a lot of a lack of urgency because people were feeling a lot of anxious about the election. You kind of want to see where the chips fell. Now you have kind of half the country relieved and half the country wanting to move to Canada. So what do you see being at least the short-term impacts of the election on the housing market going forward?
Yeah, well, we finally have the results now. So builders are really now looking to understand and really price in and prepare for what they see as the effects of a second Trump administration here. And I think there are kind of three main areas that builders and just really the housing market in general and economy is preparing for. And that's going to be inflationary pressures, especially around tariffs. They're looking at deregulation and the effects of that. And then they're also going to be looking at labor very, very closely. So if we talk about inflation first, the biggest factor there is really going to be tariffs. So tariffs, when they're instituted, and tariffs are unilateral, by the way. The president is able to institute tariffs, place tariffs on goods without Congress. So that is a unilateral decision that the president is able to make in his administration. So when we look at tariffs, there's a bit of a wait and see, of course. We're not sure if it's going to be targeted tariffs on Mexico and China, or it's been floated, a blanket tariff on 10 to 20% of 10 to 20% on all goods coming into the U.S. So tariffs, when they're implemented, tariffs are paid by businesses that are importing goods from other countries in the world. But what happens with those tariffs is those businesses aren't just going to eat the cost a lot of times. Yeah. Theoretically, foreign businesses might be able to lower their prices, which offset some of that. But in general, you're looking at those costs from the tariffs being directly passed on to consumers. That looks a lot like inflation. And that looks a lot like price inflation. And so that's something that we're watching very closely. The biggest effect of that for the builders in particular is really going to be on material prices. It's different variations of how exposed certain parts of the building products and material world are to tariffs. But really, appliances, electrical equipment, hardware, lighting, those are going to be the ones that have a very high exposure to tariffs because a lot of their imports of the finished goods and of the intermediary goods as well, because that's a very important factor to think about in tariffs as well. Those come from overseas. Some materials like concrete, some stone, steel, those ones are less exposed to overseas imports. But in general, when you have tariffs and they're looking to onshore, the opposite of offshore production to the US, really the reality is that takes a long time. So at least in the short term, especially if we see blanket tariffs kind of across the board, that could be really significant pricing and inflationary pressure in the economy that could drive up building material prices, which drives up construction costs. That also theoretically can drive up mortgage rates. And we've seen the bond market with the 10-year treasury has gone up about, I think, 20 or so basis points just since the election results, because the 10-year treasury, which is what mortgage rates are really priced based off of, that really reacts to inflation expectations. So if the bond market is expecting higher inflation, if the Fed is expecting higher inflation, then you might be expecting interest rates to go up for longer.
And would you expect those retaliatory tariffs? I mean, President Xi in China is unlikely to just sit idly by if the United States imposes significant tariffs on China. That's unimaginable.
Yeah, no, that's the other factor there. And it's not just, China, for example. We've been in a sort of a trade war back and forth with China for a while now. But, if we have 20% tariffs across the board on all goods coming to the U.S., that affects a lot more countries than just China as well. But retaliatory tariffs, export controls, those could all really impact supply chains as well.
Those tariffs, I was going to say, those tariffs were really focused, weren't they? Like semiconductors, they were absolutely, and there's support in the international community for U.S. tariffs on semiconductors, because it was true that China was sort of dumping those. But if they're sort of blanket and just really, really non-discretionary, then that's a different kind of tariff, I guess.
Yeah, exactly. And the messaging matters too. And this goes into regulations as well. If there's very unclear messaging, it's not, specifically targeted and really about, competing with a geopolitical rival, then there's going to be a different sort of effect that you're going to see. And especially with regulations. So if we go and step away from the tariff question and step into regulations, there we are also talking about inflationary pressures as well, partly because we're talking about tax decreases with the extension of the Trump tax cuts, as well as other really kind of stimulatory things that they're talking about for the economy with reducing taxes, which would reduce costs, but that could in theory also drive up inflation, which drives up mortgage rates, which isn't great for the new home market. But overall, one thing to understand with the regulation is that while there are definitely things the federal government can do, the biggest constraints on builders, on the really housing market and development world in general, comes at the local level. We're talking about local municipalities that are making it really tough to entitle, approve, and get new developments going. The federal government doesn't have really all that much control over that. There is some stuff they can do. The Army Corps of Engineers, wetland permitting, EPA, that is a big factor in a lot of markets. They could also theoretically do some incentives for density or permitting improvements through the ability to offer certain funding or maybe withholding funding as a stick. But in general, really when it comes to deregulation, the federal government only has so much control there. So it could help, especially if we do see some big movement on changes in federal laws that could impact, zoning requirements or potentially if there's more federal land available. Though one thing to keep in mind with that federal land, it's not always in desirable areas where people want to go.
Yeah. Or areas with water to service that. A lot of that is in the arid West. And, Water's water. I'm in California. I do most of my work in California. So believe me, I know it's excruciating how these localities are just ludicrous about and how onerous their entitlement process. I'd love to see regulatory relief in all these California jurisdictions. But one of the biggest problems with it isn't just sort of the laws and things like that. And they used to, often their restrictions are really because they don't want any growth, not because they act like they want a specific kind of growth, but that's a dodge. So what can the federal government do with respect, though, to the timing, to dragging their feet, which is one of the biggest costs for developers and builders when these localities just take forever to do every step along the way? Is there anything, that may be a rhetorical question. I don't know if there's anything the federal government can do about that.
Well, I mean, I think one thing we can do is look a little bit to the states. And, we know this in California. California has taken moves. We've instituted the builder's remedy where theoretically, if, the municipality is refused to allow any new development, that the builder can say, okay, here's what I'm going to build instead, and then just do it. It's been done a little bit, but not very much,
Yeah. Well, you know what, Dillan, actually, I don't know if I should say this, but it's used as a little bit of as leverage, is saying, here's a beautiful, wonderful development that we could do that could provide housing, absolutely crucially needed housing, if you agree to it. And they say, oh, no, we want whatever, something ludicrous, or they're just really anti-growth, period. Say, well, okay, I guess we can do 40 to the acre, very low income, below market rate instead, because the law allows us to. And they say, oh, well, let's talk. So you do see that kind of behind the scenes, not infrequently.
Yeah, we do see it behind the scenes. But, despite the fact that we have these, measures implemented, California is still one of the hardest places to really get land entitled, develop, all of that sort of stuff. So even though there has been movements at the state level, especially on the timing thing, we're really not seeing a ton of improvement in the way that California really needs, because we have a really severe housing crisis in this state.
Can I bring up something scary, though?
Go for it.
Because one of the things the federal government could do would be with respect to mortgage origination and just mortgage regulation, like do something against Dodd-Frank. Dodd-Frank is a red tape nightmare, but it's also something that has kept those mortgage originators from doing really dumb things they did in 2002 and 3 and 4 and 5 and 6 and 7 and 8.5. So is there something, it's fearful, but do you think there could be something along those lines to free up more mortgages and therefore sort of juice demand artificially? We know what the end of that story looks like, and it's a cliff, but do you think that's a possibility?
I mean, it's possible that something like that could happen. But again, I think you mentioned it before, the supply story is really what's key here when we're talking about housing. The reality is there is demand. There is tons of demand in the market. Yeah. The problem is that supply is just too low, which is keeping prices too high. So people can't afford to get into those homes. So theoretically, yes, there could be some stimulus towards demand, which would get some people into homes. But again, we're just talking about kind of furthering the cycle of there's really high demand and very low supply.
I know, but it would, you're right. No, you're right. But it would free up some of that demand at those lower points. That first-time buyer would, air quotes, benefit from that kind of a mortgage origination environment temporarily, at least, until they get closed out. So I mean, you could generate some demand at that part of the curve, but you're right, it'd be very difficult to supply that kind of demand anyway.
Exactly. Yeah, it's a two-sided issue. We need demand, but we also really desperately need supply. And I'll talk one more thing that affects both of these two is the labor challenges and the labor story right now. So there's a couple of different parts of this. When we're looking at immigration into the U.S., that's actually a big supporter of rental demand kind of across the country, especially in markets with large amounts of immigrants. And really, I mean, there's two parts of this again. There's the legal and undocumented immigration. With legal immigration, if we see that start to decline because of any regulatory changes or just different messaging that's out there, that could be a bit of a headwind for rental demand, as there are simply fewer people out there looking to rent apartments. And we have in some markets pretty significant supply of new units coming onto the market. So we'll have to keep a really close eye on that. When we talk about the undocumented labor out there and undocumented immigrants, really about 23, % of the construction labor force is made out of undocumented immigrants. So on the labor side, the construction industry is already kind of facing a problem in that there really just aren't enough laborers to do the jobs that are needed, especially of really a lot of the skilled laborers who have, a lot of those folks have aged out of the industry. And now there's a bit of a gap where we just don't have workers. So, in reality, if we see mass deportations, that's going to be another headwind for the labor story and for builders, which is going to, again, increase costs and decrease the really ability for builders to build things on a scheduled, essentially, and really streamlined way. So that's something that they're definitely worried about too. Again, this is still a wait and see though. Just like the election was a wait and see, everything that's coming up is a wait and see now too, because we won't know until 2025 when the administration has shifted and we get really the first signals of what this administration is going to look like.
And the immigration thing really could go both ways. You could have, we've had a lot of deportation. There was 1.3 million folks deported in 2023, calendar 2023 by the Biden administration. So, there's still a lot more, as you said. It's a huge. There's millions, 11 to 23 million illegal immigrants here in the U.S. But mass deportations would have this labor supply kind of crunch. But if you're smart about it, you could have something like some kind of a guest worker program or something like that for construction specifically, or for other industries that are heavily impacted by that labor shortage. It's just, so we just don't know if you're going to have sort of smart federal policy actions, or just sort of, less smart federal policy actions, to be diplomatic.
Yeah.
Just remember that when Trump was president before, he halted the H-1B program, which we think of as bringing in like high-tech engineers, et cetera, but it also has the guest worker component. And a lot of businesses were really hurt because they didn't get those folks coming in for the summer, right? So if he does this, if the same action is taken, it can be super restrictive and impact certain markets significantly.
Yeah, or you can be, or there's someone in his ear that you can be a little smarter about it and be a little more forward thinking in terms of the impacts, in terms of how to alleviate these impacts. So again, like Dillan said, it's just super uncertain right now. If I had one word for the future, it'd be uncertainty, which is a great segue to talk to Jody for what we'll end this episode of the podcast with, which is kind of our official look forward over the near term, at least, of what John Burns Research and Consulting is saying about the future.
Okay, to recap a couple of things we've already talked about, there's the uncertainty about tariffs, possibly driving higher material costs, immigration policy, things that we just talked about. I think that what we can expect in 2025 is that builders will maintain their focus on those speculative starts, maybe even increase them, because what happened during the COVID period was pretty quickly, they didn't know what it was costing them to actually build the homes or how long it would take to build the homes. And, people who had signed contracts later on couldn't close because rates had increased. We can have, for somewhat different reasons, a similar outcome in which builders have to really delay selling the homes until they're pretty far along, really know their costs, and can put a price tag and also promise an accurate delivery date. So I'm thinking we will see continued very high focus on those speculative starts.
Okay.
We have been seeing strategies like land banking and diversification by the builders themselves into the build to rent. I think we're going to see more of those because both of them solve certain types of volatility and exposure to cycle changes and just give more flexibility. So expect more of that for 2025. We did survey the builders about their outlook for the year ahead. I think Cara might have covered this, but I'll just recap the numbers. Nationally, and these are weighted averages for year over year growth, the builders we surveyed forecasted 10% community count growth. So that's open storefronts where they're selling, and also 10% growth in their sales. Makes sense, ties to the communities. 11% growth in the single family starts, and 8% higher closings nationally. So we thought these were pretty optimistic views, despite a variety of challenges and a lot of uncertainty. We did ask this before the election, but still, builders are pretty optimistic folks.
Okay. I wonder if we ask after now, and I presume we probably will in the very near future, is there angst? Let's end it this way, Jody, if we can. Sort of, kind of, what is the most worrisome thing to build, as you think, looking forward, and maybe what is the thing they're most optimistic about? And now after the election, that might the first part that might be changed now. It might be tariffs or immigration. Do you have any sense of that?
I think it's probably the cost and timeliness of building, what kinds of material shortages might, emerge, things that where we don't have control of the components here in the US or finished products. So I think that is definitely a big concern for them and would really jeopardize these optimistic growth goals for 2025 if we end up in some kind of gridlock there on what they can actually build, which, as we said, with supply and demand, could actually make housing even more expensive. We are forecasting higher rates for longer, and we're not alone in thinking that. I actually don't think that is a huge issue right now for the builders because they already have figured out the mechanisms, and Cara did a great job describing how individualized the conversations are about helping buyers who are seriously interested, get over to the finish line. Those rate buy downs, the forward commitments, help with closing costs. And remember that we are seeing now a growing percentage of transactions in the housing market in which wealthier boomer, I know we don't call them boomers, but just for everyone else, kind of think the boomer generation, this is a pretty wealthy group, and they are contributing to help their kids and their grandkids gain housing. And oftentimes these young people with this kind of financial help, they're buying like a nicer or bigger home than you would have expected them to be able to buy on their own, right? So the grandparents are saying, don't buy this little tiny home, plan for a move up, plan that you're going to have a family. Like hint, hint, we want grandkids. You're going to need more bedrooms. Don't underbuy.
Subtle
right?
pressure.
Kind of
I like that.
Yeah,
That's
exactly.
That's a smart move. It's a flex move from grandma and grandpa. That kind of implies, Jody, that then the tariff part is the most worrisome thing maybe for builders because, like you said, we don't control most of the material that goes into building a home. Like lumber, you slap a tariff on Canadian lumber, and you just jacked up the price of a house dramatically, instantaneously.
Yeah, in talking with building product clients over the time, as well as our really robust team, it takes a long time for factories that produce products like, let's say, OSB or, a variety, even cabinets, right? All these different components that go into homes. It's a really big runway for them to expand their production capacity, for them to find and hire and train people, et cetera. It's not a quick fix. It's not like we can flip a switch and double up on building these products in-house or in-country, rather. So I think that is probably one of the biggest risks. And I think when we think about opportunity, I mentioned the rates. I think the builders feel confident. They know what to do. We've been tracking these interesting shifts that are taking place with the domestic migration. And then everybody knows we had massive moves happening like during COVID, and some of that has ceased and maybe even a little bit reversed. But an interesting trend that we've noticed when we're out in the field talking with builders is buyers moving into adjacent markets. So it's sort of expanding naturally in a way, the possible footprint for the builder. We talked to a bunch of builders in Orlando, and they were talking about, hey, we're also selling in Daytona and in Melbourne, Palm Bay, and Lakeland. And these are all technically separate metro areas that are adjacent. So even though it looks like Orlando is like losing domestic households on a net basis, they're not going that far. They're going into these surrounding areas for affordability and for quality of life. And so I think for builders, it actually gives them a wider target, if you will, of where they can build and sell homes.
And builders have know that supply is unlikely to explode anytime soon, probably never, at least in the near term. And they've really figured out those strategies to get those folks into a door that they now own. And that's been a huge boon to new home builders. I am super appreciative. We're over an hour now, so let's sign off. But I really appreciate you guys coming on. Jody and Cara and Dillan, let's do this again in spring. Let's just do it twice a year.
Mhm.
This is fun. And this is super informative. I hope you, the listener, enjoyed this as much as I did. Thanks a lot for coming on.
Thanks for having us.
Yep, thank
Thanks,
you,
Dean.
Dean. See you in spring.
Okay. Well, I'll see you all before then. But this is Dean Worley for the New Home Insights podcast. Join us again next time when I'll probably make the 100th dumb joke about Florida and alligators. I don't know. I've not been keeping track, but probably around there. We'll see you then.